All right, good morning, trade pros. Welcome to the morning market update for Wednesday, May the 1st of 2019. It's George Papsov, Trade Pro Academy. It's May, the beginning of the 5th month of the year. It's wild how fast time flies by. And yet here we are, beginning of May. April's ended, and we have a new month and a new all-time high on the S&P 500. Overnight, it traded up to 29.61 quarter on the futures. And, we're seeing quite a bit of momentum, something that we've sort of looked forward to and anticipated the breakout to new all-time highs. And here we are. All right, so we're continuing higher on momentum. Today's a very important day. Morning market fun fact here, number one, since Jerome Powell turned a little bit more dovish and went more flexible with his interest rate policy out of the Federal Reserve, happening for the first time this year on January 4th, S&P is up 20%, all right, and only logged two one-day declines of more than 1%. So you want to know what's causing this upside in the market? The Federal Reserve is, all right? It's simple. Low interest rates, cheap money for longer periods of time. It's funny how that will transpire to some upside bullishness. It's always been the case. Remember, don't fight the Fed. It's a very actually, the saying is more don't fight City Hall, but the Fed is part of the City Hall. All right, today the FOMC is expected to leave borrowing costs unchanged. We're not expecting an interest rate hike or an interest rate cut. We're expecting no decision or no action being made. But we are looking forward to the press conference where Jerome Powell is probably going to talk more about being patient. That's the one word that we need to focus on very carefully. That's the trigger for institutional traders to take action. All right, if it's more patient, that means, hey, you got some more time, at least another quarter or so of low interest rates. If they say, you know what, patience is sort of something we're looking at closely, and they remove it from their statement altogether, that means rates are going up next time around. It's very cryptic, but the word patience is super important. I don't think they do anything with it today. I think they still remain patient and wait for new data to see what their forecast is going to be. No rate hikes. Their economic outlook will not change. They're not actually providing one today, and there's going to be a press conference. I think today's FOMC event is going to be less exciting and eventful and volatility driving than typical other ones. It's sort of one of those FOMC events you just have to get through. Jerome Powell's agenda this morning is, all right, just get through the day, don't say anything crazy, and you're good to go. All right, and I don't think that's going to cause too much market volatility as we sit at these highs. I think they're just going to reaffirm the exact same thing we already know. Here's the danger for Jerome Powell. He'll want to avoid being too dovish, meaning too accommodative with monetary policy, or another way to say that is lower rates, all right, for longer periods. That's accommodative. He'll want to avoid that strategy because the U.S. economy is doing pretty good, actually. You're seeing at the last couple numbers, retail sales, GDP numbers beat. The advanced GDP was up 3.2%. Last time around. All right, everything's looking good. The job market's tightening. We have an update this morning also on the job labor market. Here it is, 275,000 jobs added by the ADP numbers versus 180,000 expected. That's a huge beat. And the prior numbers revised higher from 129 to 151. So back month revision to the bullish skew as well. So that's kind of, that's as bullish of a report as you want to see. That puts the onus on this Friday's non-farm payroll numbers, because the ADP jobs report is a good predictor for what non-farm payrolls will look, sound, feel, and be like. All right, so there's a tightening in the labor market, another indication of it. All right, and so if Jerome Powell gets too dovish, then the Federal Reserve is going to lose credibility, because why are you so dovish given the economy's doing so well and with a tight labor market? All right, you also want to avoid being hawkish. Right, so you wouldn't want to say that, hey, we're going to start raising rates soon again, because last time you started raising rates, the market crashed. Last time you stopped raising rates, it went up. Obviously, people want to see the market go up all in all. All right, being a little bit more hawkish would spook the market, and any hawkishness in this press conference and Q&A will have a bigger impact on the stock market than a dovish statement. Because if he's dovish and being more accommodative, great, the market's at all-time highs. There's really only so much we could factor in this one run up before we get a pullback. Now, if he gets too hawkish, right, I think the sell side is loaded with sell stops below. There's a lot of liquidity, and hawkish statements here will lead to trouble for the market. It'll drop quite a bit. So that's kind of the only thing you got to watch for. A hawkish surprise on this event will be the most volatile market moving event. All right. Also, Donald Trump yesterday tweeted he wants the Federal Reserve today to cut interest rates by 1%. All right. Uh, and return to quantitative easing. That's good. That's actually kind of funny. That should have been morning humor of the day. I don't think he was joking, though. I think he seriously expects a 1% cut today. For all other traders and market participants who aren't expecting a 1% cut, it's going to be a pretty uneventful day from the Federal Reserve, given we don't get any hawkish surprises. Yesterday, we had Apple earnings, which were bad, but the stock is up 6%. All right. Here's the good news of the Apple's earnings. They boosted their dividend by 5% to 77 cents a share versus last year. It's also a 5% increase this year, 16% increase last year. So Apple's paying out more of their cash flow to their shareholders, which is a sign it's becoming a mature company. All right. Now, shareholders love to see dividends getting paid out, but what that means is there's no other place to put that cash, which means, are they doing enough research and development? Are they going to continue to stay on top of the industry with new products? If they're able to pay out all this cash flow, it's kind of a sign of saying we have nothing better to do with this money. All right, which a company goes from the growth stage of its life cycle to the maturity stage. And nothing's wrong with that. I mean, look at Microsoft. It's been a mature company for decades, and it's doing really well. All right, but it's a sign. They've also authorized a larger buyback than expected, meaning Apple's going to go out and buy their own shares. That's a clear boost to the stock because, a big buyer buying shares creates more demand than expected. So that put a little bit of upside in the share price alone. Here's where it gets interesting. Q2 revenue of $58 billion, down from $61.1 billion a year ago, but above the 57.49 expected for the second quarter. Now, get this is going to be a trend. All right. Overall, total annual revenue decline for Apple. Q2 earnings per share of $2.46 was released, down from $2.73 a year ago, but also above the $2.37 expected for this quarter. Q2 iPhone revenue of $31 billion versus expectation of 30.5 beat, all right, down 17% a year over year, or from a year ago from 37.6 billion. Q2 China revenue, $10.22 billion, down 22% from 13 billion year over year. All right, Q2 service revenue, 11.45 billion, up 16% from 9.85 billion. So that's a really good, strong number. Services revenue is where the iPhone or Apple is headed. All right, they're exiting slowly the hardware business. They'll never exit, but they're deleveraging from hardware and going into services sector. All right, Q2 gross margin 21.82 billion. So basically, here's the story of Apple. It did better than the low hurdle that was set by analysts, but year over year hasn't really done that spectacular. In fact, it's down in all categories. I think the exciting thing is Tim Cook saying the China slowdown in iPhone sales is starting to reverse. He's seeing a little bit more momentum. So it's sort of, yes, we're down, but it's starting to move towards the right direction. Here's why that's interesting, because Huawei and other phone companies are really saturating the market with feature-rich phones at like 1/3 the price, right? That's the real competition in China, because they don't really care to have the latest iPhone. Most consumers just want the features that the phone has, all right? And if somebody else provides it at a lower cost, they go for it. Obviously, there's a small subset of the market that will do anything to get the iPhone, including line up at a store for a day and a half. And those people are doing it for other reasons than just the features, all right? They want the brand association. That's what's important to them, all right? They want to be early adopters. That's their image. In today's markets, there's going to be reduced volatility into the European close, because Europe's closed, so is Asia. Japan's closed, Hong Kong's closed, China's closed, India's closed. In Europe, at midday, London's down 0.2%, Paris is closed, Frankfurt's closed for what we call May Day. All right. You know what's ironic about that? Everyone is off on May Day except Theresa May, because she actually has 3 meetings that she's hosting for the Brexit. Interesting stat. So everyone except May is off on May Day. Crude oil is down 0.4%, rebounding a little bit. Gold's flat. Bitcoin's up 0.2. We had a strong ADP jobs report this morning. 10 a.m. we have ISM manufacturing. We also have construction spending. 10:30 we have crude oil inventories. The best time of the week, where in 1 hour you can make your full weekly income, and we trade that together live with our group. 2 p.m. FOMC announcement, and 2:30 Jerome Powell press conference. I'll tell you this much: if it wasn't for the FOMC today, the market would be very slow. Europe's closed, Asia's closed. All right, expect lower volatility, lower volume all the way until 2 p.m., which is the Federal Reserve. All right, I think we're just going to put in some consolidation, some swings at these highs, build out some value, or volume and see where we go from there around the FOMC. We are trading the FOMC meeting minutes and press conference live with our elite team. So elite team, stay tuned for that. We're going to start at 1:45 p.m. We'll trade the event at 2 p.m. and the press conference at 2:30. All right, guys, that's what I got for you today. Watch for this market. Yesterday we saw some selling propensity, got absorbed. We're up to new all-time highs. Watch support levels below, and if they hold, long side's the right side. Today I expect less volatility though. All right, remember, once again, Asia's closed, Europe's closed. There isn't going to be that much overlap in the session. Or volatility or volume for that matter until the Fed. And if Asia and Europe's closed and there's nobody really trading from those sessions, that takes away volume from the US session. And if you're a US session trader, you haven't traded with anyone already, and you're probably waiting for the FOMC, which builds an even more kind of patient approach. All right, stay patient today, scale down the size, take less trades, and wait for volatility to ramp up before you do. All right, take care. Have a good day. Time to open up the trading room with their team. Trade pros in the room. Thanks, Marky. Trade pros in the room. I'm going to queue up some support levels for you. Looks like the market's selling off a little bit as expected. Yesterday we got a nice sell-off. They got absorbed before we continued the rally. Today I have one key level that I'm looking at that presents a really high probability, low risk opportunity for an entry in this market. All right, I'll share that with you on the S&P. Victoria will talk about NASDAQ and Steven will cover oil. Let's get into it.